Hello, everyone, and welcome to the latest LPL Market Signals. Jeff Bookbinder here, your host for this week with my friend and colleague, Dr. Jeffrey Roach. How are you today, sir?
Doing very well. It's always nice to have the Jeff and Jeff show for this edition.
Absolutely love it. So, even though it's pretty cold outside here in Boston, I am feeling pretty good today. I think we're going to bring you a good show. Got a lot of good stuff to talk about. Certainly coming off of a good week in the markets, which helps our mood. After we look at these disclosures, here is our agenda. Rally continued last week. Nice gain for stocks, but just wanted to highlight that it was a little bit narrow. Next, we'll talk technicals. Our weekly market commentary this week is a technical check-in, I guess you could say, where we'll look at the S&P and at the 10-year yield. Next, and this will be your section, Jeff, we're going to talk about some emerging cracks in the economy. Not trying to be scary or anything like that. The point of this is just something to watch out for. It shows maybe this economy is poised to slow down. And then finally, the week ahead. It's actually a pretty fun week to preview, Jeff, because we have CPI, which is big, of course, with all the attention on inflation. We also have retail sales, which is an important report as we get closer to holiday season. Earnings, whole bunch to talk about as we preview the week ahead. Biden-Xi meeting. There'll be a lot there. So let's get to it. I'll do this recap maybe a little faster than I normally do to leave more time for the meat here. But the market was up about 1.5% last week on the S&P. So a solid week, of course, led by mega cap tech. So you see here on the sector side, the tech sector was up almost 5%. You see consumer discretionary up 1%. You see that's where, of course, Amazon and Tesla are housed. You see comm services up over 2%. That's where Alphabet and Meta are. So that's mega cap tech. That's really the story. A lot of people ask, can that group continue to rally? And frankly, with the earnings strength that we've seen and the improvement in the macro environment, I'm talking about cooling inflation and evidence of stability in interest rates. The fact that we're in this favorable seasonal period right now, it really just started over the last week or so. We actually think the big cap techs can finish the year strong. We see more upside. The flip side of the mega cap techs is the small caps, right? So the Russell 2000 small cap index was only was a big laggard last week, down a little over 3%. The Nasdaq was a big winner, up 2.5%. Of course, that's from the mega cap tech names. Small caps continue to struggle. This isn't a news story. They're actually down 12 of the last 15 weeks. So market clearly favoring the big guys with the strong balance sheets. The international markets couldn't keep up with the strength of mega cap tech, so you saw some lagging there. Strong dollar was certainly a part of that. But late last week, we did see a little bit of a bounce in Japan. So moving on, the bond market sold off a little bit. Rates did back up a bit. The 30-year bond auction was a little bit of a disappointment, the Treasury auction. And you did hear Powell talk tough on inflation. So, a little bit of a negative week in the bond market, but not too much. So yields are in the 465 to 470 range on the 10-year as we're recording this Monday, November 13th, 2023 in the afternoon. The commodity markets were weak. There's probably a little bit of China concern in here, but energy is the biggest laggard in the commodity space lately. You had oil down about 4% last week, and dragging the energy sector with it. That continues to be an area of weakness. We think it'll find its footing soon, but the supply-demand situation in oil has been a little bit bearish. Too much production, too much supply, and we haven't seen the Middle East situation spill over to the point where it would impact Iranian production. So oil, trying to get back above 80. We think there's some upside there, but we are in a little bit of a seasonally weak period. So let's move on to technicals, and then we'll get into the economic situation. So starting with the 10-year yield, I mean, you could argue the 10-year matters more than the S&P here. We have, pulled back from 5%, as I mentioned, into the 465 to 470 range. We're watching 435. If we can get to 435 on the 10-year, that would break the uptrend and potentially bring lower yields into play. Now, that's just a technical perspective. You certainly have the fundamentals at work here too, but we do think inflation will come down, continue to come down. We'll see more evidence of that.
Yeah, Jeff, I just want to jump in here for a quick promo. We talk about the weekly market commentary, which you did, Jeff, in the outset during our agenda. Just to remind the listeners, that is on our LPL.com website. And so you can get a little bit more into the weeds on where these charts are sourced. So LPL.com under the newsroom is where we have our weekly market commentary.
Yes, thank you for that, Jeff. So these charts are from that section of our website. This was put together by Adam Turnquist, our chief market technician, and he certainly is very adept at identifying these support and resistance levels, identifying these trends. So 435 is the number to watch on the 10-year yield. 4,400 is the number to watch on the S&P 500. We're right around that number today as we're recording this. Did break above it Friday, but we really want to see that level hold for a period of time to break the downtrend in the S&P 500, which is really the mirror image of the uptrend that we've seen in the 10-year yield. Here's where I said that this has been a narrow rally. We've had these two straight really strong weeks for stocks, but if you look at the percentage of stocks in the S&P 500 that are above their 200-day moving averages, that's how we identify uptrends. It's actually quite low now. Last week, it dropped from 44% to 42%. And as you'll see here on this next slide, when you're in the 40s or lower on that metric, forward returns tend to be weak. So, of course, this doesn't hold every time, but if we stay in the 40s, that is at risk, or go lower. That is increasing the risk that this market is down over the next several months, or maybe even as long as 12 months out. That's this quintile 5. If you break the breadth into these 5 quintiles, and you see the performance is best when you see really strong breadth readings. So this is a real key ingredient for the market to finish the year strong. We need more breadth, right? Small caps aren't working. If we can get better performance there, better performance down the market cap spectrum beyond mega caps, we think this market will be in a much better position to make its next move higher. So really interesting analysis there. We did break an 8-day winning streak last week. The good news here is that after you end an 8-day win streak, subsequent returns have historically been very strong. So here you see 9.1% average gain 12 months after the end of an 8-day win streak in the S&P 500, which happened last Thursday. So, this is, certainly you don't want to base an equity market view on this alone, but this is just one of a number of studies building historical evidence that this market can go higher over the next year. You'll see that in our 2024 outlook. We do think this market will go higher in 2024. So now I'm going to hand it over to you, Jeff, to talk economy, moving right along. Hopefully we're not scaring folks by saying cracks are emerging. I mean, we just came off of a really strong quarter for GDP, right, in Q3. And it looks like we're going to have more economic growth in Q4. So, economy hanging in there pretty well now. But why don't we tell our listeners what we should be watching here?
Yeah, I think in the same way that we look at the technicals, trying to get a good view on where we are, what the base case should be, where the risks are either to the upside or the downside. I think in the macro space, you want to do the same thing. Anybody looking at markets, you want to say, okay, what are some leading indicators And the big question before we show the chart, Jeff, the big question really should be in people's minds: can the very, very strong growth rate that we had in the third quarter be sustained going into the fourth quarter? Or are we at this late cycle idea where, that we can't keep growing that much above long-term trend? And so I think one of the important factors to look at is how leveraged consumers are. Where are they tapping to be able to keep consumption high? And that was really the driver in the third quarter. But really, even right out of the gates in January of this year, consumers were spending very, very strong. So go to the next slide, and we'll see where the potential cracks are. And again, this is one of those things where we say, all right, this is not necessarily a recession indicator, but it's a leading indicator that provides evidence about the sustainability of growth. And so, you look at this is basically serious delinquencies, which means people that are past the 90-day mark for credit card payments. That's the dark blue line, and auto loans on the orange line. Granted, it's obvious you can see a lot more volatility in the credit card space, which makes sense. Certainly smaller balances than what you're looking at from your car loans. And so both of those metrics, in terms of the balances that they're carried forward, are reaching highs relative to where we were pre-pandemic. So Jeff, you think about the economy in 2019, 2018, right? We had some trade wars. We had a lot of debate, particularly in DC, a lot of political banter. And we were really kind of near a late cycle of this long moderation, right? So if you look at this graph and you say, okay, look at the gap in time between the two gray columns. That's just basically telling you, we had a recession, the great financial crisis, we call it, in the 2008 timeframe. And we had several years of solid growth, no recession. It was quite historic, the length of time between the two recessions. Now, granted, COVID was an unusual type of recession, but we were slowing down before COVID as an economy. Consumers were slowing down. And so I think that's a really key point to think about where additional pressures might be. And then another key takeaway from this chart is to say, okay, we know that the percent of unpaid balances is higher on those two loans. You could think, we're behind those payments, not keeping up to speed. And you want to think, well, what's going to be the penalty? Clearly, the penalties are going to be a little bit higher than they were, say, in previous eras, just because interest rates are much higher. Interest rates on credit cards near all-time highs, and then, of course, interest rates across the board. So let's go to that next slide, Jeff, because in the context of interest as it impacts the average household, this is something that I thought was helpful to think about. You say, okay, on the surface, you say, all right, well, non-mortgage interest rate payments as a percent of wage and salaries is not as high as we saw, going back to 2005, going back to the 90s. But I think what really, I guess, impacts the household the most, this is kind of a behavioral finance kind of concept, is it's the speed at which things change. Jeff, you and I, we talk about this sometime in our asset allocation committee meetings. It's that additional derivative. So it's the rate of change, and then it's the acceleration or deceleration of that rate of change. So, and we don't do well, we as humans, with quick changes. And that is, I think, the way you want to think about this chart right here. So as a larger chunk is going toward interest payments, and the change in which it's going toward interest rates has never been faster. That steep line there has never been that steep ever. And so, again, I think to follow up, Jeff, on what you were saying, cracks emerging, is that overly bearish? Not necessarily. I wouldn't say it's bearish, but it's definitely a yellow flag for caution. This is something we're watching because we want to make sure that we're looking at leading indicators and not catch ourselves flat-footed as the economy turns from 2023 to 2024.
Yeah, I mean, I guess the good news is that consumers have continued to spend, but as interest costs eat up a larger proportion of their incomes, they're not going to be able to spend at the same clip, right? That makes perfect sense. But we handled it pretty well in, the middle of the last couple cycles here. I mean, you can see in the 90s and the 2000s, we were up here or even higher. So, that's maybe the bullish take on this, is this economy's done fine at higher interest rate cost levels, right? I mean, heck, you could even go back to, the late 80s, early 90s, right? Certainly we had a recession around then, but, generally speaking, the economy, continued to, chug along from what, 82 to 90. So,
Right.
Higher interest cost levels, higher interest rate levels, even though rates came down. So this should be manageable, but I understand what you're saying, Jeff. It's a shock to the system when you're used to 0 and then you go to 5%, seemingly overnight.
But I think too, it's one of those things to say, well, what causes us to be a little more sore or tentative when there's another shock, outside of this, right? So you go back several decades, you're just referencing, long-term capital management, clearly a shock. The tech bubble, a shock. The '01 attacks, a shock. So it's one of those things to say, okay, where are we maybe kind of, getting a little bit teetery, and then, that I guess provides a little bit more of a greater warning. If trade, for example, this is hot off the press, Jeff, we haven't talked much about this yet, but in terms of, the news about water levels in the Panama Canal being low, right? So that's going to affect trade. We don't know to the extent that it'll truly, ripple through and affect the consumer, but things of that nature. Granted, it's hard to forecast shocks, right? Who would have ever forecasted COVID, for example, right? But it certainly puts us maybe in a little bit more of a tentative position.
Yeah, absolutely. So good discussion there. Let's continue the economic discussion, Jeff, and talk about all the data that we have this week. So I highlight what I think is important on this economic calendar every week here. And I have a lot of yellow. So, it's pretty obvious that the CPI matters. It's pretty obvious that retail sales matters. That's a big piece of the economy. I think probably something like 15% of the economy. Jeff, you can correct me if that's way off, but I think it's something like that. But housing really matters these days because you've got interest rate sensitivity, as we know, with high mortgage rates. So I've highlighted some housing data, and jobless claims really matters, right? We're watching the job market closely. That number's ticked up. And some people watch that as an indicator of recession. If it moves by a certain amount, somewhere around 50 to 75,000 claims off the lows, you tend to get a recession. So we'll watch that one closely too. I highlighted that. I guess that covers it. Oh, and small businesses matter. So we watched the NFIB small business survey. So got any calls on any of this data? What should people be paying close attention to, Jeff?
Well, I think one major takeaway from the slide here, and yes, a lot of things highlighted. I guess you could argue that you could even have more highlighted, right? Import prices, maybe not anymore, but when we were very concerned about supply chains impact on consumer prices, import prices could also have been highlighted. I think the key takeaway here is this is going to be a first look in this first month of the fourth quarter. So you can see in that column, most of this is for October. And so I think that's why markets are going to be focused on some of these reports. We're going to get a decent look. To your point about retail sales, this is not the most comprehensive metric on the consumer. We have to wait a little bit later in the month. Have to give government data collectors a little bit more time because the retail sales report is heavily focused on goods. It does have restaurants as services, but most of our economy is a service-based economy, and so that's why you could say, "Oh, retail sales certainly gives us a good first look," particularly in some of those cyclical components like auto sales, and that's something that's going to be worth focusing on. And then, of course, on Tuesday the 14th, we're recording this, by the way, on Monday the 13th. And, tomorrow we're going to have that inflation metric. And I think the reason why markets will be focused there, of course, is that we're going to see a pretty decent moderation in the headline month-to-month number on the back of declining energy prices. So that's certainly going to be I guess you could say, one of the positive things that we can look at for this coming week.
Yeah, certainly core is more closely watched by markets and by the Fed. But core, some of those lower energy prices sometimes seep through to other areas of the economy. Maybe not quickly enough to show up in the same month, but I don't know if you've studied that, Jeff, but it seems to me like when you have good news on the headline, you usually don't get bad news on the core.
Well, you're right. It pays to go into the details, and that's kind of the key point of why we're here at LPL Research, to dig down into the details. It's going to be, services. It's going to be clearly rents. That's been one of those categories we're waiting for that to show up in the official metrics. But you're right. It's very important to dissect these numbers, whether it's just the headline or the core, which, by the way, core for our non-financial listeners, that is excluding food and energy. And I see it right there. You have it typed out. So good call out there, Jeff.
Thank you, Bloomberg. So, we're looking for 0.3% month over month on core. I like that expectation coming in because, if you get 0.24, you're going to round it to 2 and the market could rally on that, right? We really want to string together some 0.2s and some 0.25s to get where we and where the Fed wants us to be. If you string together a bunch of 0.3s and you end up at, close to 4 for your annualized number, that is not so comfortable for the Fed. So that one we'll be watching very closely. I haven't looked at the Atlanta Fed GDP tracker, but I last I looked, at least middle of last week, I think it was already down under 2. So makes sense that we wouldn't expect another booming 5% GDP number in Q4. But certainly if we get a booming retail sales number, we'll be, kind of in a position to put up a better number than maybe people think. And you really don't have to start thinking about recession until probably you get into, a couple quarters into next year.
That's right.
At least. So I guess the other thing we got this week is, we got a couple of things. Earnings, right? I think it's just a dozen S&P 500 companies, but some big retail names: Walmart, Target, I believe Costco, Macy's, TJX, Gap. There's a Home Depot. So we're going to get a sense for how the consumer's shaping up here pretty quickly. So that will be interesting as well, especially as you get closer to the holiday shopping season. Some people would claim that we're already in the holiday shopping season as we prepare for Thanksgiving, or we, buy half price candy at our local drugstore after Halloween. But from what I've seen, Jeff, I want to hear your take on this too. It looks like holiday sales stand a good chance of being up year over year, but they may not be up much based on all the sort of, historically effective indicators of holiday shopping. What do you think?
Well, with a lot of the leisure travel, that still seems to be pretty strong. By the way, Thanksgiving travel is expected to be pretty strong. And that's certainly, correlates with overall holiday spending. And we could see, kind of a 3% year-on-year growth in holiday sales. Of course, the early online shopping, Prime Days, for example, earlier in the year suggested that consumers are still very interested in purchasing goods. It's not just a shift towards services. Remember, we've talked about this over several podcasts and things. We saw an overall shift to services away from goods, maybe coming out into 2022. But it's amazing how strong the consumer has been, both goods and services. And so at this point, like I said, this is going to be a key week for understanding October, how things are going to flow into the rest of this fourth quarter. But so far, the cracks are emerging, as we said earlier in the podcast, but it hasn't really hampered spending quite yet.
Yeah, absolutely. If we do get a 3% increase in holiday sales, that's flat volumes, right? Essentially, that's all pricing. So, it'd be fine, but it wouldn't be great if you put it in that context. People aren't going to be getting more stuff. They're just going to be paying a little more for it. Historically, I do know that the stock market performance tends to correlate with holiday shopping. I also know that back to school shopping, which was fine, tends to correlate with holiday sales. So, it should be a decent season, but we're not gonna, blow the doors off. I'll say, because it depends on what the hot products are, right? What's going to cause people to line up? I don't know. I don't know what those products are, but we'll have to wait and see once we get closer to to Hanukkah and Christmas. So the other thing going on this week is President Biden and President Xi are meeting at this global economic summit in San Francisco. I don't know what's going to come out of that that's going to be tangible, but I think we'll continue to hear the narrative around thawing relations. And, if that leads to some real economic benefit, great. The market will respond accordingly. Maybe prospects for Boeing, for example, to sell planes to China, more agricultural product purchases. I think, Jeff, you might have written about that. So, there's the relationship is thawing, it seems, based on the headlines. And I guess, I know a lot of people have different views of China and how that relationship should go. But based on just economics and based on the market, we would like that thawing narrative to continue. And any thoughts on that meeting, Jeff?
Well, I think it's going to be key for the city of San Francisco. So maybe not a global impact per se. It's going to be more opportunities for some, photos, right? It's the photo op kind of meeting. But I think when you think about, a city that has been particularly hit with the ramifications of hybrid work, right? People can leave the city, go somewhere else, lower cost of living area, certainly have challenges in commercial real estate. I think this is going to be either a really good opportunity, or it could be the other way around. So I'm going to be looking, especially with how the city manages the summit. I think it has a lot to do with how we can see if the city can rebuild itself after a very, very difficult period of time. So it's more of a regional impact in my mind.
Interesting take. Well, we'll be watching the regional implications and global. So that's a lot for this week. It'll be another busy one, and hopefully yields cooperate and stocks can keep going higher. So with that, we'll wrap. So thanks, Jeff, for joining me this week. Thank you all for listening to another LPL Market Signals podcast. We'll be back with you next week for another edition. See you then. Take care, everybody. Have a great week.